Since 2020, the purchasing power of the United States dollar has declined by more than 20%. That means $100,000 today buys what roughly $80,000 bought just a few years ago. At the same time, global debt levels have reached record highs. Geopolitical tensions remain elevated across Eastern Europe and the Middle East. Gold has recently traded near historic highs above $2,000 per ounce. Central banks continue to accumulate gold at the fastest pace in decades. Investors are watching inflation moderate but not disappear. Interest rates remain structurally higher than they were in the 2000s. Market volatility continues to surprise both conservative and aggressive portfolios. In this kind of environment, the question is no longer, how do I grow my money fast? The question serious investors are asking is this: how do I protect purchasing power while still generating intelligent growth? And that is where automated investing platforms enter the conversation. But are they actually worth it in 2026? Or are they just another technology trend? Let us break this down carefully. Automated investing has expanded rapidly over the past 5 years. Retail participation in markets has increased significantly since 2020. At the same time, studies from behavioral finance show that individual investors underperform broad market averages primarily because of emotional decision-making. They sell during downturns, they hesitate during recoveries, they increase risk during optimism cycles. Meanwhile, algorithmic and rules-based trading now accounts for a large portion of daily market volume globally. Institutions have relied on automation for years. What has changed is access. Technology has moved downstream to individual investors. Before we go further into the pros and cons, let me briefly position how we approach this. To give you context, here's a quick overview of how we structure automation inside our ecosystem. At ATN, we help everyday investors access private, institutional-style trading systems that used to be reserved for hedge funds and ultra-high net worth individuals. The model itself is hybrid by design. Automation handles execution and monitoring around the clock, enforcing rules consistently and without emotion. Experienced professionals oversee strategy, risk management, and changing market conditions. Our clients aren't looking for excitement. They're looking for consistency, transparency, and peace of mind. Our clients want growth, but not at the expense of control. ATN was built on the idea that real, automated income should simplify your life, not add more stress to it. If you agree with that and are interested in learning more, there should be a link to speak to us in the description of this video. Now that you understand the structure and control framework, let us step back and evaluate automated investing more broadly so you can make an informed decision. Investing in 2026 is not the same as investing in 2015. From 2010 to 2019, interest rates were historically low. Liquidity was abundant. Broad equity markets trended upward for extended periods with limited interruptions. Today, conditions are structurally different. Government debt levels have expanded dramatically. Fiscal deficits remain elevated. Central banks are balancing inflation control with economic stability. Supply chain fragility has not fully disappeared. Military conflicts and geopolitical tensions continue to create unpredictable shocks. Gold and silver have gained renewed attention as hedges against currency debasement. Central banks globally purchased over 1,000 metric tons of gold in recent annual reports, marking one of the strongest accumulation periods in modern history. That behavior signals caution at the highest levels. For individual investors, this creates a challenge. Traditional buy and forget strategies may still work long-term, but volatility cycles are sharper. Drawdowns recover, but often with more turbulence. This environment favors structure, risk management, and adaptability over speculation. That is the lens through which automated investing should be evaluated. The primary advantage of automated investing platforms is disciplined execution. Automation removes hesitation. It removes overconfidence. It removes panic. It follows predefined risk parameters consistently. In volatile environments, discipline often matters more than prediction. Second, automation allows dynamic adjustment to changing market conditions. Some systems reduce exposure during increased volatility. Others rebalance positions based on predefined thresholds. Third, it improves time efficiency. Working professionals do not have the bandwidth to monitor markets throughout the day. Automation allows participation without constant supervision. However, the true value is not speed. The true value is structure. In unstable macroeconomic conditions, structure protects decision-making quality. That is why many serious investors are evaluating automation as a complement to traditional portfolio allocations. Automation is not protection from loss. Markets still decline. Systems still experience drawdowns. No model performs optimally in every environment. There are also structural differences between platforms. Some hold custody of funds. Some require lock-in periods. Some lack transparency around strategy design. Some over-optimize past data without robustness testing across multiple market cycles. Liquidity matters in 2026. Investors need flexibility. Access to capital should not be restricted unnecessarily. Control also matters. Investors should operate through their own regulated investment accounts where possible, maintaining authority over deposits and withdrawals. Technology should execute trades. It should not control capital ownership. If those principles are not clear, caution is warranted. Automated investing should not replace diversification. Instead, it can act as an adaptive layer within a broader allocation strategy that may include equity exposure for growth, precious metals for currency hedging, interest-bearing accounts for liquidity, real assets for diversification. Automation can provide structured participation without requiring daily manual oversight. For professionals over 35 who are building toward retirement, survivability matters more than excitement. The goal is not extraordinary months. The goal is consistent progress while managing downside exposure intelligently. In environments where currencies fluctuate, geopolitical risks persist, and volatility cycles increase, rule-based execution can provide psychological and structural stability. Automated investing platforms are worth considering in 2026 if three conditions are met. First, risk management is clearly defined. Second, you maintain control and liquidity of your capital. Third, the strategy is designed for long-term durability rather than short-term marketing appeal. If those elements are present, automation can serve as a disciplined tool within a serious investor's portfolio. If they are absent, the platform is likely not aligned with long-term financial planning. If you are evaluating automation this year, focus less on performance screenshots and more on structural integrity. At Automated Trading Network, the emphasis is on operating inside your own regulated investment account, maintaining full control of your funds, and using technology strictly for disciplined trade execution under predefined risk parameters. If you would like to understand how Automated Trading Network integrates into a broader portfolio strategy, you can review the details through the link in the description. Take your time reviewing it. Compare it carefully with other options. Make decisions based on structure, not emotion. And if this analysis helped you better understand automated investing in the current economic climate, consider subscribing and turning on notifications. This channel is built for thoughtful investors who care about capital preservation, intelligent growth, and long-term survivability. I will see you in the next video.